Hello, this is Tim Congdon, Chairman of the Institute of International Monetary Research at the University of Buckingham. It's late June 2020. The world is coming out of the lockdowns associated with the coronavirus pandemic, and I want to update you on the global monetary scene. Now, in the last few months, I've been concentrating on the USA, where there has been a dramatic increase in the rate of growth of the quantity of money. I'll be saying a bit about America again today, but I want to widen the discussion to include the other leading countries and to give a global overview. To start with the United States, we've got here a picture of the growth rates of the quantity of money on both an annual basis and a 3-month annualized basis, going back a bit over 10 years. And you can see that there's a period of stability in the middle when money growth was about 4% a year and the growth of normal GDP was also about 4% a year. And then at the end, there is this incredible leap upwards, so that the 3-month annualized growth rate goes up to almost 90%. And indeed, the increase in the quantity of money in the year to May was 25.5%, which is a record in the United States for peacetime in the modern period. Just get some history on all this. This is a picture of the relationship between that annual change in the quantity of money and the annual change in nominal GDP going back over the last 100 years. You can see that the average growth rate of money was 6.6% a year, and the average growth rate of nominal GDP was 6% a year. Does that then mean that as we just had a value of 25.5% for the increase in the year to May, that increase in nominal GDP in America is going to head up towards 25%, and then obviously very rapid inflation? Well, I don't think so, but I think what we should be prepared for is an intensification of inflation pressures over the next 2 or 3 years. And this is really the main point of the analysis that is obviously the main contribution to the current public debate. Now, there are a couple of things to say further about America, then I'll move on to other countries. The first point to say is that this increase in the growth of money, 25.5% the last year, has been the money balances, the financial sector, life insurance companies, pension funds, mutual funds, and so on, these have risen much more than that 25.5% in the last year. And I suggested in my last monthly that the increase in their money balances since the end of 2018 was over 50%. And this had really been the main reason for the surge in the American stock market since the end of March. Well, we have actually had some official numbers from the Federal Reserve for the first quarter of 2020, and they fit this story. It turns out that in the first quarter of 2020, the money balances of the US domestic financial sectors, mostly these financial institutions, went up by $300 billion on a base of about $150 billion. So an incredible leap just in one quarter. And I think it's perfectly reasonable now to just take this a bit forward and to say that, in fact, the increase in the money balances of the US financial institutions, the institutions that buy bonds, equities, and so on behalf of the American saving public, that in fact they went up by have gone up by about 60 to 70%. They're about 60 to 70% higher than they were at the end of 2018. And this is a dominant force behind the strength of asset prices and the stock market in America. And it's one of the reasons why one should expect a stronger rebound in the economy in the next few quarters than is the current consensus. I'm borrowing here from Bloomberg Businessweek, where there's a suggestion that there's a great disconnect between the economy, where output is down in the last year, and this surge of 43% in the stock market from the end of 23rd of March. Well, what we have at play here is, if you like, an unholy trinity. We have the quantity of money, we have the nation's wealth, and we have national income and expenditure. And it's crucial to my work that the quantity of money, in the end, determines the nominal value of both wealth and income. What many people think is that the wealth depends on the income. The stock market's driven by GDP. Not necessarily. It may be that, in fact, there's always money around, it chases the stock market higher, that then causes more spending, and national income catches up. But all these three things, the quantity of money, national wealth, national income, must all have a relationship with each other, and over time, they do. They all hang together. So the quantity of money is up by 25.5% the last year, carries on growing fairly quickly in the next few months and quarters. Then we have to expect that it's going to be the national income that adjusts the stock market, not the other way around. Having said that, the second point I want to make about America is that in the last few weeks, in fact, the rate of money growth has dipped a little bit. Not very surprising after the incredible surge that we went through in March, April, and early May. And this is a measure of commercial banks' cash assets, which are affected by all of the operations that the Federal Reserve carries out. And you can see it just dipped a little bit at the end. It jumped from $1.5 trillion, what is this, at the end of February, up to about $3.5 trillion at the end of April, and then has gone sideways and come off a little bit. I think it's just a pause. It isn't the end of the current fiscal and monetary spree surge that's going on in the United States. It's just a pause, but we probably have seen the highest rates of money growth in this episode in March and April 2020. Okay, now let's then do our sort of around the world in 8 minutes kind of thing. I'm going to do the various countries that see what's happened to money growth in the other world's other leading economies. Now, what we're going to see in every case is a pattern of a hockey stick. Essentially, it's flat, and then it dips up at the end, so it looks like a hockey stick. This pattern reflects, of course, similar policy responses to the coronavirus. Let's start with the Eurozone, and we can see that this is a chart going back to 2005. Ups and downs, all, by the way, related to nominal national income and expenditure and economic activity and so on. And then at the end, it hasn't lasted very long as yet, but there's a surge upwards that you can see. And then let's kind of limit this a little bit. So we're looking at taking us back not to 2005, but to 2018. And here it's a little bit cleaner. You can see the 3-month annualized rate, the red line moving up to 20%, and the annual rate moving up to still under 10%, but moving towards 10%. The last value here, by the way, is April. I'm sure when we get the May and June figures, the annual figure will be up at 10%, which will be the highest since around about 2006, I think. Just check that. Yeah, about 2006-7. Japan. Now, Japan has had very low money growth since the early 1990s. Typically 2, 3, sometimes 4%. This kind of 2-3% figure has been very normal for almost 30 years now. And in that period, Japan again has had the slowest growth rate of nominal GDP of any of the major economies. So the money growth and the nominal GDP have been related. This chart goes back again to 2005. Just check the axis on the left-hand side. You can see these 2-3% numbers. And then at the very end, taking off. And if we look at the same picture, but going back to early 2018, we can see that again, this acceleration, the 3-month annualized now is up to 10%. America, it's up at almost 90. In Eurozone up at 20, in Japan heading up to 10. In all cases, an acceleration, but very different magnitudes. And the annual figure heading up towards 5%. What about the UK? And as with the Eurozone April at the latest figure, this goes back to 2011, this chart. You can just see at the very end, again, this sort of, that line shooting up at the very end. And then if we take this back once more to early 2018, again, we have this hockey stick. 3-month annualized rate is 20%. The annual rate is about 10%. And so, again, fits the general story. This time, I think I'm going to include Canada and Australia. Canada has got about 60% of the UK's GDP. Australia about half. Together they count for more than the UK does in the world economy. So Canada, same kind of picture. But here, in fact, we've got, just as only from the start of 2018, 3-month annualized 30%. Okay? Seems like North America's got the real rapid money growth at the moment. USA well ahead of the pack, but Canada not. Canada up at 30% higher than in the Eurozone, UK, Japan. Annual rate up, heading towards 10%. Australia up at annualized 3-month rate, 25%. So we see this pattern in all of these nations. Now, what about the other big developing economies? India, again, has this pattern. In India, the banking system has a lot of government debt. The budget deficit has increased there. So you again are getting an acceleration of money growth, not as sharp as elsewhere, but in developed countries. And in China, it's the most damped of all. There is an upturn in money growth, but it's not very pronounced. I haven't got the pictures here, but that's what's been going on there. Okay, so that's the pattern across all the world's major economies. Let's try and draw some conclusions from that. First of all, there has been a common policy response. Okay, all different nations, central bankers talk together on the phone every day to each other and so on. They're doing the same kind of things. The governments, there have been lockdowns, loss of tax revenue, some increases in spending, larger budget deficits. They're funding them largely from central banks, sometimes a bit by borrowing from banking systems. And this has then led to an increase in money growth. And that's common to all of the nations that we've looked at. That then leads to this hockey stick pattern as far as those diagrams of money growth is concerned. But there is a very clear divergence between the economies, with the USA really very different from the other economies in the extremity of the move towards this accelerated money growth. So that, on the face of it, implies that US policy has been, if you wish, more helpful to the economy than in other countries. Alternatively, you might say it's been more expansionary, or as I would say, it's been more inflationary. Let me immediately add, one has to understand why these things have been done, and I'm not necessarily condemning the people who've done these things, but I don't think in the end it's going to be very good for the American inflation rate. But this is a matter of debate and controversy at the moment. China and India a little bit behind the rest of the world. Perhaps that'll be good for the relative inflation performance in the next year or two. The impact of the money supply accelerations has been very clear in asset markets, which have diverged from economies. Stock markets have done surprisingly well, have been unexpectedly resilient in this very difficult macroeconomic environment. You might say this has been a good thing, and that it's made people more cheerful and it's encouraged them to spend. Maybe, but it does, at any rate, fit in with the story that we've been telling. Obviously, we have to think about what happens when the pandemic is behind us. And whatever one says about the current crisis, in the past, all pandemics have in fact been defeated. We have gone through to periods without having to worry about illness and so on. And there is going to be, on the analysis I've given, excess money balances everywhere. More so in America than in other economies, but everywhere. This implies a period of above-trend growth and upward pressures on inflation. There's a huge debate at the moment about whether the pandemic is deflationary, disinflationary, or inflationary. Clearly, the argument I've just been presenting is that it's inflationary. And in some respects, just the final thing to say here, this is like at the end of a war. At the start of this process back in February and March, a lot of governments and civil servants and politicians said that it's like fighting a war. Well, the policy response has led to increased deficits. It has led to monetary financing of the deficits. It has led to faster monetary growth. And as happened after major wars, there's likely to be a bit of inflation. Thank you.